Everyone's always looking for a way to legally save tax. So I'm back with 5 tax tips for 2022. Hello everyone, my name is Ethan Rooshock, and as I said, I'm going to be giving you 5 tips that you can use to save on tax in 2022. So like I said, these are all going to be things that you can legally do, because it's all important about legally saving tax. But I want to make sure these strategies are easy to implement, but also can be used at a more advanced level as well. The key to any tax tip or any tax strategy is having an understanding of how tax works, because then you can start to implement strategies that go beyond this, because you have an understanding of how the tax system works, and therefore you'll come up with ideas and you go, oh, maybe that will work, and you do a bit of research and get some confirmation that yes, you can do that. So that understanding is really key, and then keeping on top of it throughout the year. But the biggest thing I always tell people is don't get caught up in just wanting to save tax. There's much more to your financial position than that. Quite often people that are paying a high amount of tax are earning a quite high amount of income. So it can typically work that the more income you make, the more tax you're going to pay. Now, there are definitely times where you do need to put strategies in place to reduce that, but just keep that in mind, especially for employment income. So the first one is using the right structure. Now, this doesn't apply to your employment income in 99% of situations. Most times that's going to have to be paid to you personally. You don't have much options there. But for income outside of that, so business income, rental income, investment income, you do have the ability to look at what is the right structure for you. Now, I've done videos on structures and talking about them in more depth, but you pretty much have the option as well, are you going to invest in your own name? Are you going to invest within a partnership or in joint names with someone else, maybe a partner? Or are you going to invest within a trust or a company? So you've got those multiple options, and it can get a little bit overwhelming for people, but it's a really important thing to get right from the start. Now, there's no right answer to this to go, yep, this is the only structure you should use, because everyone's situation is different. The real basics of it is that you can look at something like a company, which in 2022 has become more attractive because some companies are getting a lower tax rate of 25%. Now, that depends. If you're just holding investments, that may not be the case. But again, it has made that more of an attractive option. But you've got to remember, you don't get the capital gains discount in a company. So that's something to consider. But a company gives you flexibility of how much money you're going to distribute to the shareholders, and therefore how much you're going to be paying at the individual tax rates versus a flat company tax rate. So then you've got a trust, which is great for flexibility of distributions. So because a lot of trusts have as discretionary trusts, the trustee can determine how the income is going to be split between the beneficiaries. And this can be really good for splitting up income and giving it to people on lower tax brackets. So it's definitely a good tax saving strategy in the right situation. But sometimes it may be best just to hold your investments in your own name. The cost of a trust or cost of a company may not make sense. And you might be able to go, you know what, I'm just going to hold them in my name. It's not going to make any difference tax-wise. And therefore you're going to save yourself on whether it's accounting fees or whether it's legal setup fees, etc. So don't just go and set up entities because you think it's going to save you money. You want to make sure it's right for you before you actually set those up. Now, before I get into tip number 2, if you haven't already, jump over to the Rooshocks Discord. It's not only the place where I'm talking about my NFT project, but it's also a place where we're talking about tax tips. So you can drop questions in there tax related, and I'm going to answer them. Or the community may help out. You may be able to read someone else's question and also get an idea of how you could save tax. So definitely jump into the Discord. The link is in the bio. So the second one is understanding the superannuation caps and knowing how to take advantage of them where it makes sense. So the big thing with super, and I always tell people, it's going to be your own decision, or you need to go seek a qualified financial planner. Go and have a look at the video I did talking to Brad from The Guided Investor, because he is a financial planner and we talked about this kind of stuff. But you really want to make sure you've got the right advice before you go and do this. But the great thing from 1st of July 2021, so for the 2022 tax year, the super cap has gone from $25,000 to $27,500. So it does allow you to put more money into super each year as a concessional contribution, and pretty much a concessional contribution will reduce your taxable income. So you will get taxed within the super, but you're pretty much claiming the extra super contribution you've made. You don't want to break these caps, and there are carry forward from previous years if you haven't utilized it in the previous 5 years, if you have a balance under 500 grand. There's different things like that. So there's a lot more to this than just going, I'm going to put money into super. You want to make sure you're eligible to actually do it and it's going to work. But it's one of the only methods, well, actually probably the only method that I can think of off the top of my head, where you're putting money into your own really long-term savings account and getting a tax deduction for it. Now you've got to make sure that is right for you. If you're only 20 years old, you got to understand, well, you're not going to be able to access this for over 40 years. So you need to understand that, well, once it's in super, you can't necessarily just take it back out. But it definitely is a strategy a lot of people use to save tax. The third one is work-related deductions. And I've talked about this quite a bit on my channel, but understanding your industry and therefore understanding what deductions are relevant for your industry is so important in saving tax. I've talked about on my channel before about how one of the easiest ways to save tax is making sure you're actually just claiming what you're entitled to claim. And work-related deductions is the biggest one for that because people don't even know what they're able to claim. So I've heard plenty of people that have done their return through MyGov or My Tax or whatever the ATO are calling it these days and haven't claimed anything. They go, oh no, I can't claim anything. Not understanding that maybe they had a work uniform that they were washing that were able to claim laundry, or that they do use their phone for work, or they've worked from home. So there's lots of different areas that you potentially have work-related deductions. So you really want to focus on keeping receipts for this kind of stuff. So that's the other area where people go wrong, is they don't keep receipts through the year. But work-related deductions could happen any time through the year, so have a system so you can keep those receipts. And whether it's a pair of work boots, whether it's a license you've paid for, whether it's some tools, make sure you've got those receipts because it will make it much easier at the end of the year for you. Now the next part of this is knowing what you can claim, listening for advice from whether it's other colleagues of what they may have claimed, but then doing your own research on it. Too many times I've had people come in and go, oh yeah, my friend at work, they claim this. And I'm like, well, they're not able to claim that. They may have done that, but if they get an audit, that may not hold up. So listen, but then research, because you don't want to be the one that gets an audit and have done the wrong thing. Now the ATO do have some good industry specific information on the website. So search your occupation, teacher deductions, ATO, and you'll likely find some really good material on there that'll give you an idea of the stuff you may be eligible to claim. Now the fourth one is bringing forward expenses and deductions to prior to the end of the financial year, so 30th of June here in Australia. And the reason for this is you're bringing them forward and then you're claiming them in this year. So this can be great for both individuals and for business holders. So for individuals, obviously those work-related deductions we just talked about, if you're going to spend them, if you do it before the end of the financial year, then you're going to be able to claim them in that year. So, like I said, if you're needing a new pair of work boots, go do it this year. If you're planning on making a donation to charities, do it this year. If you need to buy new tools or you need to renew a license, if you do it in that financial year, then you're going to be able to claim it. So you think, if it ends up being, say, $1,000 purchase, that could be $300 or so tax back, that if you do it in that year, you're going to get that back much quicker than if you, say, did it in July. You're going to have to wait nearly or over 12 months, potentially, before you get that tax refund side of it. Now, businesses have a lot more flexibility here because there's a lot more different deductions they're going to do. So their deductions can also be at a much higher scale. So it may be purchasing a new vehicle or some equipment for your business, or maybe renewing your rent for the next 12 months or insurances. So there's lots more you can do when it comes to businesses, when it comes to, well, which financial year is it going to fall in. But for both business and individual, the key thing is having an understanding of what your current income levels are, therefore current tax rates, and what your expected future incomes are going to be. Because it might not always be the best idea for you to bring something forward. You may be expecting a really high tax year the next year, and therefore you may be wanting to defer expenses. And the same goes for income, is that you can utilize these same strategies there. So maybe you're in a business and you know you've got lots of income that's going to be coming up, but maybe you might delay invoicing that, or you may take a little bit of time off in June because you go, well, I'm going to do some of that in the next year because I've already had a really big this year and it makes sense to do that. So understanding where you're at and where you're going to be at is really key for this tip. And then the fifth one, the last one for today, is tracking and understanding your capital gains positions throughout the year. So what I mean by this, and I've talked about capital gains quite a bit on my channel, but you really want to have an understanding of where all your positions are at, whether they're stocks, whether they're rental properties, whether they're crypto, especially when you're considering selling. Now the reasons for this is again come down to the timing. So obviously if you're selling this financial year and you've made a large gain, you'll be paying tax on it in this year. So you could do that strategy we've talked about before, but in reverse where you defer the sale to July. Now you may have other situations where you've already recognised some losses this year. So you want to recognise some gains because maybe you want to utilise those losses in this year. So again, you may recognise those gains in this year. So it's understanding where you're at. And a lot of these strategies do come down to having a good understanding of what your current tax position's at, where you want it to be at, and maybe where it's going to be at in the future. So to be able to utilise this strategy, you need to be tracking your capital gains through the year. So having an understanding of where your positions are at. Now rental properties is normally a little bit easier because you normally know what you paid for it and hopefully a rough idea what your house is worth. And that process takes a while if you're going to sell. For something like shares, are you using some kind of software such as ShareSite, or you're using a spreadsheet to be able to go, yeah, this is my unrealized gains. Again, for crypto, are you using some type of crypto tax software and having an understanding of what your cost base is for your assets, and therefore what the implications will be if you're sold? Are you in a gain position or a loss position? I think in summary, those 5 tips are quite simple, but they can be really powerful when it comes to saving tax. It all comes down to having an understanding of the tax system, and therefore having an understanding of your own situation and how the tax system's going to fit into that. Thank you so much for watching. I really appreciate it. I hope it's helpful for you. As I have mentioned before on the channel, I am a tax agent, I'm an accountant, so if you are needing help with your tax return here in Australia, make sure you do get in touch with me. But overall, I just appreciate you so much for watching the video, and I'll talk to you again soon.